9 stories dropped this week. Most of them were reported as housing news. Every single one of them is an investor signal. Here's how we read them. Welcome to Smart Real Estate. I'm Addy Saeed, licensed real estate broker through Max Gold, partner at Westcliff Asset Management, and your host. This week, I'm flying solo. 9 stories, a dense policy week, and some market data that deserves more attention than it's been getting in the headlines. Before we get into it, if you're not already part of our Smarties community, head to learninvestmanage.com. Free sign up, free tools, free access to school community, no catch. Let's get into the data. So 3 frames are running through everything today. First, the GTA market is tightening, but prices are still falling. The headlines are calling it momentum. The sales to new listing ratio is at 35.7%, which says otherwise. Second, government is pulling every lever it has on supply costs this week. I'll tell you what each lever actually buys, but the math is more nuanced than the announcement. Third, the labor market beats expectation in May, but 2 of Canada's top bank economists read it very differently. I'm giving you both reads and letting you decide. So TRREB released the May Market Watch numbers on Tuesday. Let me give you the headline numbers first, but then I want to go into the data that actually matters for multifamily investors because there's a lot being missed in the general coverage. So 6,583 sales in May, up 6.3% year over year. New listings were down 18.9% to 17,698. Active listings were down 13.3% to 26,927. Average price? $1,069,700, down 4.6% from last May. The MLS HPI composite benchmark is at 946,500. That's down 6.8% year over year. Days on market is rising. Average listing days on market are up 8% to 27 days. Average pending days on market is 7.7% up to 42 days. And embedded in TRREB's economic indicators, Bank of Canada's overnight rate is at 2.3% or 2.25, prime at 4.5. 1-year mortgage rate at 5.49%, 3-year at 6.05%, and 5-year at 6.09%. Toronto unemployment is at 8.1% as of March. That number matters for everything I'm about to tell you. Here's where it gets specific for multifamily investors. Condo apartments took the hardest hit of any property type. The HPI apartment benchmark is down 9.12% year over year, nearly double the 4.7% decline in detached. And there's an inversion that doesn't happen in a healthy market. 416 condos averages are now at 573,531 versus 905 condo averages are at 639,468. Downtown Toronto condos are cheaper than suburban condos. That tells you something specific about where the supply pressure is. The 416 condo corridor is absorbing a wave of investor-held units hitting resale simultaneously, units bought in 2020 through 2022, now coming to market as holders face negative cash flows. The 905 has less of that concentration, so it's holding relatively better. Toronto Central sales to new listing ratio trend is at 31.6%, well below the already soft GTA-wide 35.7%. And that 35.7% is itself still a buyer's market territory. A balanced market is 40 to 60%. We're at 35.7%. Until that clears 40% on a sustained basis, prices won't recover. TRREB is calling for prices to flatten and begin rising towards 2027. That's plausible, but the data doesn't guarantee it and hardly supports it. From the ground in Mississauga, which is my market, 568 sales, averaging 971,000. Sales to new listing trend is at 34.4%. Months of inventory is at 5. Buyer's market in Peel. Mississauga condo apartment benchmark is at 521,100, down 7.83% year over year. If you bought a condo investment property in Mississauga in 2022, you're underwater on prices, likely negative on cash flow. The holders I'm seeing in the market right now are making decisions about whether to absorb the loss or wait it out. That tension is what's keeping active listings from falling further. So the GTA is tightening mechanically. Fewer listings, not stronger demand. The sales to new listing ratio at 35.7 must clear 40% sustained before prices will respond. Don't price in a recovery that the data doesn't support yet. Condo apartments are the most distressed assets in the GTA. The 416 inversion versus the 905 signals concentrated investor exit pressures in the downtown core. If you're holding a negatively geared condo investment property, model your exit at today's prices, not at 2022 prices. The math has changed materially. If you're a buyer with long hold thesis and strong cash flow underwriting, the entry math on the 416 corridor is more interesting than it has been since 2018. Something worth watching. Active listings declining as sellers pull rather than cut prices. A psychological floor is forming. It can crack quickly if Toronto unemployment 8.1 rises further or refinancing pressures intensify. Watch monthly unemployment as a leading indicator. The May job report dropped Friday and it beat expectations by a wide margin. I want to give you two reads from the same data because RBC and CIBC are landing on different places, and both of those views feed into how the Bank of Canada thinks about rates. So, the numbers Statistics Canada reported 88,000 jobs added in May. The consensus forecast was 10,000. RBC had projected 25,000. The unemployment rate fell to 6.6% from 6.9% in April. Ontario led all provinces, 42,000 jobs created. Toronto's unemployment rate fell to 6.8%, its lowest since November 2023. Full-time employment jumped 154,000, but part-time fell 66,000. So wage growth slowed sharply to 3%, down from 4.5% plus in each of the two prior months. And here's the number that puts all of this in context. Employment is still down 5,000 year to date in 2026. So RBC's Nathan Jansen calls it a welcome upside surprise. Layoffs have been declining since October 2025. Per-person conditions are gradually improving, and he's cautiously optimistic. That's the bull case. CIBC's Andrew Grantham titles his note Back to Life, but maybe not reality. He flags something RBC didn't. 3 of the 4 biggest sector gains in May, construction, info and culture and recreation, and food and accommodations, are sectors that may have been temporarily boosted by World Cup preparation. Ontario and BC drove most of the gains. If that's a tournament effect, June pulls back. And with employment still down year to date, May's print just brought us back to where we were, not forward. Both agree on the punchline for real estate investors. Bank of Canada stays on hold. You need sustained labor market tightening and an acceleration in core inflation before rates move. Neither is here yet. If you're planning financing around variable rate cuts this year, I'd build your model on hold, not on cuts. So key takeaways, 88,000 jobs is a big deal, but employment is still down year to date. May brought us back to where we were, not forward. The World Cup flag from CIBC is the bear case. If Ontario and BC gains are tournament related, June will pull back. Don't extrapolate May numbers as a trend. And Bank of Canada is on hold, and that is the consensus from both RBC and CIBC. Build your financing models around it. And Toronto unemployment is at 6.8%. It's improving, but still elevated. Household formation suppression continues to weigh on rental demand recovery. Something to watch. Wage growth at 3%, sharply lower, suggesting lower paying jobs dominating the mix. That's a consumer purchasing power signal that affects how quickly rental demand can recover in the GTA. This is a segment where government policy meets institutional reach, and I want to be very precise about what is being promised versus what the data actually says. I have 2 Tier 1 sources here, the government announcement and CMHC's own modeling of the exact scenario being announced. These 2 documents should be read together. So the Development Charge Reduction Program launched June 1st, up to $8.8 billion over 10 years, cost match federal and provincial. Municipalities that cut development charges by 30 to 50% or more gets funded for housing enabling infrastructure. Applications are open now and the deadline is June 19. That's 12 days away. More than 200 of Ontario's 444 municipalities currently levy development charges and are eligible. The program requires municipalities to maintain their development fees reduction for at least 3 years and to contribute a minimum of 10% to project cost. Now, here's the analytical layer. CMHC separately modeled exactly the same scenario through their Housing Development Viability Analyzer. They looked at what happens to project viability when you cut development charges by 50% across 4 cities. In Toronto, that produces approximately 5% more viable development projects and translates to an estimated 4,900 to 7,650 additional units being built annually. Eliminate development charges entirely, and that jumps to 10,000 to 16,250 units per year. That sounds like a lot, but CMHC estimates Toronto needs 31,500 units annually to restore 2019 affordability. Even full DC elimination closes only 1/3 to 1/2 of that gap. The geographic variation is also important. Ottawa only sees 1.3% viability improvement from the same 50% cut because Ottawa's DCs are already lower. The policy works hardest where the barrier is highest. In Toronto, where development charges have been adding 6 figures per unit to development costs, the impact is real. The program is the right lever. CMHC's own research confirms it moves the needle. It also confirms it doesn't solve the crisis on its own, and the impact varies dramatically by market. So a couple of key takeaways. June 19th is the application deadline. Watch which GTA municipalities apply. That tells you where the supply pipeline improvement is most likely to materialize. A 50% development charge reduction or cut equals 4,900 to 7,650 additional units annually per CMHC modeling. Meaningful contribution to the supply gap, but not a solution. Policy impact is highly localized. High development charges markets benefit the most. Low development charge markets see minimal viability improvement from the same percentage reduction. And lastly, voluntary participation is the wild card. The program only delivers if municipalities move before June 19. Some councils won't. Something worth watching. CMHC modeling assumes development charges are the binding constraints. In some markets, construction costs, land prices, or zoning are real barriers. Development charges don't fix those. Know which constraint applies to your specific market before pricing in any policy benefits. All right, so this one is an urgent one. CMHC just updated their operating expense benchmarks for Ontario, and the new numbers take effect tomorrow from recording. If you have an MLI or an insured multifamily application in progress and you're near coverage thresholds, this segment is the most actionable thing from today's episode. So here's what changed. Wood frame maintenance and repair up $110 per unit per year, from $830 to $940. Wood frame management, which means property management, is up 25 basis points to 4.5% of the effective gross income. Wood frame salaries up $55 to $610 per unit per year. Concrete maintenance and repairs up $115 to $1,090 per unit per year. Concrete salaries up $70 to $770. Elevator maintenance reserve up $15 to $315 per month. Taxes, insurance, utilities unchanged as you actually use actuals. So why does this matter mechanically? CMHC uses these benchmarks when underwriting your financing on MLI Select and other insured programs. Higher benchmarks mean lower underwritten NOI. Lower underwritten NOI means lower maximum insured amount and tighter debt coverage ratios. If your deal is close to the coverage thresholds, these changes can affect your maximum loan directly. Any application submitted before June 8th is still assessed at the old benchmarks. That window closes tomorrow. If you have a deal in progress, call your mortgage broker today. So key takeaways: submit before June 8th if your deal is near coverage thresholds. Old benchmarks apply to any application received before that cutoff. Wood frame Ontario new benchmarks: $940 for M&R or R&M. $610 for salaries, 4.5% for management. Concrete in Ontario is $1,090 for M&R, $770 for salaries, and 4.25% for management. Higher benchmarks compress underwritten NOI and reduces maximum loan amounts, which tightens your debt coverage ratio. Model the specific impact on your deal before submitting. Performance going forward must use the new numbers. CMHC will apply them whether you do or not. Something worth watching. These increases reflect CMHC's view that operating costs have structurally risen, consistent with what operators are seeing on the ground. Some would argue the new benchmarks still understate reality in high-cost markets. Know your actual operating cost baseline and flag any gaps in your financing discussion. Quick break. If you're finding value in today's episode, share it with one person in your network who invests in Ontario multifamily. That's how the Smarties community grows. And all of the tools, frameworks, and market analysis we reference in this show are free at learninvestmanage.com. Sign up and you'll get access to the school community as well, where the conversations keep going between episodes, and let's keep it going. So around 1 in 5 rental listings in Canada now offers some kind of incentive. Free rent, gift cards, cash bonuses, internet packages. In the GTHA, Greater Toronto Hamilton area specifically, 66% of new completed purpose-built rental projects are offering incentives right now. A year ago, that number was at 32%. It's doubled in 12 months. National average for rent hit $2,027 in May. That's 19 consecutive months of decline. The most common offer is 2 months of free rent, which effectively cuts the headline rent by about 13% for a tenant who negotiates it. Here's the investor signal. Face rent and effective rents are two different numbers. If you're underwriting a new acquisition and a landlord is quoting face rent, you need to ask what concessions are being offered. The effective rent is what hits your NOI. If you're a GTHA operator in lease up right now, this is your competitive environment. The incentives doubling in 12 months tells you exactly how much buying power you actually have. So key signals: build your NOI on effective rents, not face rents. The 13% gap from 2 months free is material in your underwriting. And quality products in strong locations is still outperforming. This is a location and product quality story, not just a market story. Fitzrovia's 45% tour to lease ratio versus the 10% industry benchmark is the evidence. At last week's Land and Development Conference in Toronto, the institutional operators made their position clear. Fitzrovia CEO Adrian Roca laid out the math. All-in cost basis on purpose-built rental land is down 34% from 2022 peak pricing. Net effective rents are down 21%. That gap is real today, but if you deliver in 18 to 24 months, you're walking into a market that's been starved of new supply for 3 to 4 years. Fitzrovia is a net buyer. Fiera Real Estate broke ground on 4 new projects in the past year specifically to avoid delivering when everyone else does. One site came across Fiera's desk this week, priced 40% below where it was a year ago. Two things worth flagging. First, Roca's bull thesis is explicitly conditional on rent controls not being reintroduced by the provincial government. He's projecting high single-digit to low double-digit rent over the next 3 to 5 years if that condition holds. That's a material assumption, and one I'd flag in any underwriting. Second, core Toronto locations are still clearing above $100 per buildable foot for well-located sites. Poor quality locations are getting hammered. Position matters more than the timing does. So the key signals, the 34% cost basis versus 21% effective rent gap is the underwriting tension for this movement. Patient capital that can absorb the gap and deliver into supply-starved market is in a strong position. And rent control risk is the variable embedded in every institutional bull thesis right now. It's the single assumption that most affects the return math on a purpose-built rental development started today. So London, Ontario posted 1,965 housing starts through April. 82% of those are apartment units. That's up from 367 the same point last year. More than 5 times the pace. CMHC is calling it the best start for the London housing sector in 10 years. Here's the investor tension in this story. All the new rental supply is landing in a market where population growth is muted. CMHC is forecasting a vacancy rate to keep rising and rents to keep falling in London as supply catches up. Strong starts are good for affordability, but they're not necessarily good for existing operators. That's a cautionary counterpoint to the land buying thesis I just covered in segment number 6. Institutional operators are bullish on buying land right now to deliver into a supply-starved market. London shows you what happens if that supply actually arrives. Know your demand side before you price in any supply thesis. So strong starts data cuts both ways. More supply today means more competition for tenants tomorrow. Secondary Ontario markets can flip from undersupplied to oversupplied faster than primary markets. Ontario just became a co-equity investor in a stalled Scarborough housing project. The Building Ontario Fund is putting up $178 million in Scarborough Junction, a joint venture with Republic Developments and Harlow Capital. 1,700 rental units, 350 of those affordable at below market rents for 40 years. Transit connected to Scarborough Go. Construction starts in 2027, first occupancies by 2030. The key phrase in this release, the project was previously stalled. The mechanism here is worth watching and understanding. This isn't a grant. The Building Ontario Fund takes an equity position, closes a financing gap that private capital couldn't fill at current market conditions, gets repaid, and then recycles the capital into the next stall project. That's closer to how institutional co-investment works than a subsidy program. If this model works in Scarborough, and we won't know for a few years, it becomes a template for unsticking stalled projects at scale. There's a lot of stalled projects right now. So government as gap equity co-investor is a new model for Ontario. The revolving capital structure means that it can scale without unlimited fiscal commitment. Execution is the variable. Watch whether BOF, Building Ontario Fund, can move quickly enough to materially affect the development pipeline. Mississauga approved pre-zoning for 35 major transit stations areas this week. And this one's personal for me because it's my market. Pre-zoning means height, density, and permitted uses are locked in upfront before a developer submits the application. The projected build-out across those 35 nodes, 227,000 residents and 47,000 jobs. For investors and developers in the 905, this is a legibility signal. Pre-zoned, transit-connected land in Mississauga is now easier to underwrite, easier to finance, and easier to move on. One caveat I want to be precise about, the implementing zoning bylaw still needs to come back to council for final approval. The direction is clear, but it's not fully locked in yet. When that bylaw drops, watch the specific station areas that are included. That's where the land value conversation starts. I've been watching several of these corridors for years. The approval certainty alone changes the financing conversation. So key signals, pre-zoning is one of the most underrated supply enabling tool in Ontario. It removes the approval variable that adds years and millions to project costs. Municipalities that adopt it signal a materially different development environment. And watch for implementing bylaws. The specific station areas named will tell you exactly where the investment signal is strongest in the 905. So 3 things I want you to take from today's episode. First, the GTA resale market is tightening, but it's a mechanical tightening driven by fewer listings. not stronger demand. The SNLR, sales to new listing ratio, is at 35.7%, is a buyer's market territory. Condo apartments are the most distressed asset class, and the 416 versus 905 inversion signals the investor exodus from the downtown core is still in progress. Don't mistake tightening for recovery. Second, the policy environment is pulling every lever it has. Development charges or DC reductions, HST relief, and the Building Ontario Fund, pre-zoning in Mississauga, these are all real. But CMHC's own research tells you exactly what each lever buys. A 50% reduction in DC in Toronto adds only 4,900 to 7,650 units annually. Meaningful, not a crisis solution. And the CMHC benchmark update with June 8th deadline is the most immediate actionable item from today. If you have a deal near coverage thresholds, the window to act is literally today. And number three, the labor market is better than expected, but not yet recovered. 88,000 jobs is a big deal and a big beat. Employment is still down year to date. CIBC's World Cup flag means we can extrapolate May numbers. And both RBC and CIBC agree Bank of Canada is on hold. Plan your financing around that reality. That's a wrap for this week's episode. 9 stories, a dense policy week, and some data that I think deserves more attention than it's getting. If you want to go deeper on any of this, the full analysis, the underwriting framework, and the market data, it's all free at learninvestmanage.com. Sign up and you'll get the access to school community where we keep all those conversations going. Share this episode with one person who invests in multifamily. That's how we grow. I'll see you next week, Smarties. Addy Saeed is a licensed real estate broker with Remax Gold Realty Inc., RICO license 4735346, founder and general manager of Westcliff Living, and an OSC registered dealing rep. The host may reference companies or entities in which they hold ownership or financial interest, including Westcliff Asset Management, Westcliff Living, Olympus Property Group, and Finalize LLP. Listeners should be aware of these relationships when evaluating any commentary in this episode. The podcast is for informational and educational purposes only. Nothing in this episode constitutes legal, financial, mortgage, or investment advice. Always conduct your own due diligence and consult qualified professionals before making any investment decisions. Past performance is not indicative of future results.